Lesson of Finance, Academy of Finance, Level License, Key Things to Know by Isabelle Dermant-Ferrer. We will begin by an introduction. In the first part, we will see accounting concepts, assumptions and principles. And in the second part, we will make an introduction to financial statements. Concerning the first part, accounting concepts, assumptions and principles, we will see objectives of financial reporting, accounting underlying assumptions, accounting principles, accounting constraints, and qualitative characteristics of financial information. Objectives of financial reporting. 1. Provide useful information to investors and creditors for decision making. Assumes users have a reasonable understanding of business. 2. Provide information to assess the amounts, timing, and uncertainty of cash inflows and outflows. And 3. Provide information about resources, assets, and claims to resources, liabilities. Point B. Accounting underlying assumptions. We will see basis for generally accepted accounting principles, GAAP. That is, we will see entity assumption, periodicity assumption, going concern assumption, and monetary assumption. Entity assumption. Each business is its own accounting entity. Periodicity assumption. Divide economic activities into time periods for reporting. Going concern assumption. The company will remain in business and will carry out existing commitments. Assets will be used to bring future benefit and liabilities will be paid. Monetary assumption. Assume the dollar is stable over time. No adjustments are made for inflation or deflation. Accounting principles. In this part we will see historical cost, revenue recognition, comparability, full disclosure, and matching. Concerning historical cost, assets and liabilities are recorded at cost. Cost is the best estimate of fair value at the time the transaction occurs. Revenue recognition. Show revenues on the income statement when the earnings process is just to be complete or virtually complete. That is, you do not owe the customers anything else. There is reasonable certainty as to the collectibility of cash. That is, you believe you will be paid. Comparability allows users to identify similarities and differences one year to the next or one company to another. A format for financial statements is required. It shows trends over time. Full disclosure. All relevant accounting information must be disclosed to users. The notes to the financial statements are required, and the notes to the financial statements discuss details that are not shown on the financial statements. Matching. Expenses incurred should be matched with the revenues earned for the same period. The following point is about accounting constraints. That is, consistency, conservatism, materiality, and cost-benefit. Consistency. Use the same accounting policies and procedures from one period to the next. FASB gives choices of how things can be reported, and once you choose a method, you keep using it. Conservatism. When estimating, present the lowest asset value, the highest liability amount, and the lowest net income position. 1. Recognize losses as soon as you know about them. 2. Recognize gains when you collect the cash. Materiality. The amount is big enough to make a difference in the decision of a reasonable person. Cost-benefit. The benefit must exceed the cost when gathering and presenting financial information. The next point is about qualitative characteristics of financial information. The financial information must be quantifiable, relevant, and reliable. Quantifiable means that financial statements report only transactions and can be expressed in monetary terms. Relevant means capable of making a difference in a decision. 1. Helps the user predict the future. It's predictive. 2. Helps the user evaluate past decisions. It's feedback. And 3. Current and available when making a decision. It's timeliness. Reliable. A user can rely on it and have confidence in the information. 1. Represents the economic position as it really is. Representational faithfulness. 2. Several individuals will reach the same conclusion. Verifiable. 3. Doesn't sway the user's opinion, be objective. Neutrality. So, we have finished the first part about accounting concepts, assumptions, and principles. Let's study the second part, the introduction to financial statements. In this part, we will see the purpose of financial statements, what does each financial statement really tell you about the business, additional information on the financial statements, elements that are reported on financial statements, the accounting equation, guidelines, footnotes, and auditor's report. Purpose of financial statements. The purpose of financial accounting is to record, summarize, and report transactions of the company. Transaction, record, summarize, report. What does it mean? Transaction. An act that creates an exchange of something for something else. Provide a service or goods to a customer in exchange for cash. Purchase a delivery truck, pay cash for the truck. Pay an employee for work. Pay the utility company for providing electricity. Receive money from the bank and agree to pay it back later. Most often, the exchange is giving or receiving cash either now or in the future. Record. Enter each transaction into a system. Record what is increasing or decreasing. Use descriptive names for accounts to put things in categories. Summarize. Net the impact of the increases and decreases for each item account. The total of accounts will be what you have and what you owe. What you have earned from providing goods and services, and what it costs you to provide goods and services. Report. provide useful information to investors and creditors regarding cash flows, resources, assets have, and obligations, liabilities, owe. 4 primary financial statements are used: balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. Report 2, internal users, managers who plan, organize, and run the company, or external users, investors who invest in the company, creditors who loan money to the company. Point B, financial statements. We have the balance sheet, the income statement, owner's equity, and cash flow statement. Balance sheet, the definition. Balance sheet is composed of assets, liabilities, owner's equity. Show assets on the left and liabilities and owner's equity on the right. Total assets must always equal total liabilities plus owner's equity. States what your business owns, assets, and owes, liabilities, on a specific date. Also shows the amount owed, assets, less liabilities. Definition of income statement. Revenues and expenses, gains and losses compose the income statement. List revenues first and then expenses underneath revenues. Revenues less expenses equals net income or loss, profit or loss. Shows how much the business earned during a period of time. This is what you have earned from providing goods and services, less what it costs you to provide goods and services. Statement of owner's equity definition. Shows the activity of shareholders, owners, during a period of time. Shows receipt of funds from shareholders and payments back to shareholders in the form of dividends. Shows the earnings of the business that go to the shareholders. Some companies present a statement of returned earnings showing earnings and dividends paid only. And what is a cash flow statement? The cash flow statement shows the source of cash and what the cash was used for during a period of time. Warning: cash and income are not the same. So, what does each financial statement really tell you about the business? Each statement has a heading that states the company name and the date or time or period covered. Purpose of the balance sheet. The balance sheet shows assets and liabilities and ownership equity on a specific date, what the company has, and what they owe on a certain date along with the ownership interest. What is the purpose of income statement? The income statement shows revenues and expenses, gains and losses during a period of time. That is, how much the company earned during a specific period of time, monthly, quarterly, year. So, you have to make a difference between the balance sheet and the income statement. The balance sheet is a snapshot at a certain date, for example, at the beginning of the period or at the end of the period. You have two balance sheets. But the income statement is a variation during the period. So, for example, if you have the stock, in the income statement, it is a variation in stock, but in the balance sheet, it is the level of stock. What is the purpose of owner's equity? It shows the activity of owners, receipts of funds and dividends paid. Shows the earnings of the business that go to the shareholders. That is, what occurred that impacted the owners of the company during a specific period of time. And what is the purpose of a cash flow statement? It shows the source of cash and what the cash was used for this period. Cash generated from day-to-day operations, used for additional cash from, that is, how much cash was generated from day-to-day operations. What the cash was used for. Where additional cash came from and how much was received. The next point is about additional information on the financial statements, but we will see this point later. Let's examine the elements that are reported on financial statements. So we will see the asset, liability, stockholders' equity, revenues, expenses, gains and losses. So, what is an asset? It's something that a company has, owns, or controls. The company's economic resources used to operate the business. So, what the company has or owns? You must have three conditions. 1. Probable future economic benefit. 2. Owned or controlled by the company. 3. Resulting from a past transaction, something that has already occurred. So, the economic benefit is using the asset to generate future cash flows, or the asset itself will convert to cash. For example, a receivable is an asset. What is a liability? It's something that a company owes. The company's debts and obligations. So, what the company owes. 1. Probable use of a future economic benefit, an asset. 2. Owed. 3. Resulting from a past transaction. So you will give up an asset to pay what you owe. For example, the word payable indicates it is owed. What is stockholders' equity? It's what is owned by the owners of the company. Earnings kept in the company, financing provided by the owners. 1. Owner contributions to the company. 2. Less dividends paid to owners. 3. Plus profits and less losses, also called net income. So stockholders' equity is also equal to total assets less total liabilities. What are revenues? Goods or services provided to a customer. Earned from providing goods or services in exchange for an asset. This is the amount the customer is expected to pay for the goods or services he received. A revenue occurs when the good service is provided to the customer regardless of whether the customer has paid or not. What are expenses? Using an asset of the company to provide goods or services. That is, what it costs the company to provide the goods or services to a customer. A service or good is provided to the company that the company will have to pay for. The expense occurs when the company receives the service or the asset is used up, not when the company pays for the goods or service. For example, use up an asset, prepaid, inventory, supplies. You were provided a service that you will pay for, employees' work, electricity, advertising, interest, taxes, etc. What are gains or losses? They occur from selling an asset. Loss, get less than what you originally paid for it. Gain, get more than what you originally paid for it. Important. Revenues and expenses do not occur when the cash is received or paid. They occur when the good or service is exchanged. Revenues, the company gives the good or service. Expense, the company receives the service or uses up the asset. Net income, revenues less expenses, will not equal cash. The next point is about the accounting equation. The accounting equation must always stay in balance. Assets equals to liabilities plus stockholders' equity, that is have, equals to owe plus own, includes net profits. What you have you owe for or own outright. Revenues less expenses equals to net profit or loss. And now, what about guidelines? Guidelines established by various accounting standard setting groups in consultation with accounting professionals that give guidance on 1. What type of financial information must be provided? 2. What format to use to provide information? 3. How to measure assets, liabilities, revenues, and expenses. You have 3 different guidelines. FASB, Financial Accounting Standards Board, is a primary accounting standards setting authority in the US. SEC, Securities and Exchange Commission, the government agency that oversees US financial markets and accounting standards for public companies. IASB, International Accounting Standards Board, is a primary accounting standards setting authority for several countries outside of the US. So, financial statements that follow consistent guidelines are comparable among companies and much easier to interpret for investors and creditors. So, what about footnotes? Footnotes are additional information provided after the financial statements. You have 3 types of footnotes. 1. Provides a description of the accounting rules followed. 2. Provides more details for the items listed on the financial statements. 3. Provides information on things not listed on the financial statements. The next and last point is about auditor's report. Auditor's report. A professional accountant examines the company's financial statements and gives a report that determines if the statements are fairly stated in accordance with repository GAAPs or IFRS. Thank you very much. It is the end of the introduction. If you want, you can continue with the lesson on the balance sheet.